Alright, hello, this is going to be another video on a very, very high probability entry model, as well as some additional theory examples, and kind of a simple trading model, which is what I've started to switch over to using over the past couple weeks. So starting off, this is a bit of like a niche PD array, or if it's even a PD array, but something called the Quasimodo level, where it's an old high or old low, and it doesn't really make any sense as to why it might work, just looking at this alone, which is why I kind of disregarded it a while ago. But after watching price and backtesting, this is something that I've come up with. So a lot of people might take, for example, an IFVG entry to confirm the CSD. Some people might take the zeussy market structure shift, which is pretty good. We have a SIBI, a high, then we form a BISI through it, and then we continue off of that. So that's an example of a bullish fair value area. However, something that I want to propose that you may add if you're already using the zeussy market structure shift is to use what I'm calling in this example the fully invalidated CSD. So essentially here we're actually having this high inside of the SIBI be a bearish fair value area reaction, and then from there we need to see this high, which reacted to the bearish FVA, become our bullish FVA. So essentially the bearish FVA is becoming our bullish FVA. So we're still using the PD arrays, but essentially we're chaining them all together. So kind of the reason for this is, why is the zeussy market structure shift enough? Well, obviously it'll be enough if you have your entire high time frame correct and you know when the swing low or swing high is going to form. However, this is a potential scenario that could happen. So if we have, for example, expanded lower, retraced higher, expanded lower, retraced higher, as I explained in my previous videos, if we haven't actually touched this bearish fair value area, then this whole price range from here to here is imbalanced, and now we have engineered liquidity. So what could be happening is that we have this SIBI, this high, this BISI, we displace through it, we react from this bullish fair value area, but it's simply a low time frame market maker buy model for this U right here, but it's actually the left side of the curve for a market maker sell model continue lower because we have this bearish fair value area. So we haven't had a bearish fair value area actually kind of getting invalidated for the buy program to continue. So here what I'm proposing is that we actually have this high inside of SIBI, inside of the traditional zeussy market structure shift, to actually have reacted from a bearish fair value area. And so when this happens, we're not only creating a bullish fair value area, but we're also invalidating a bearish fair value area. So at the same time, we're not only expanding higher, but we're also kind of inversing this bearish fair value area. And so this bearish fair value area actually becomes the new bullish fair value area because it overlaps with this high. And so obviously the very, very first target would be the opposing high right here, because once a fair value area is expected to fail, we can then target the high or low as that liquidity point. So then you could go break even, for example, there, or you could take off some cons. Depends on what your sizing is, how tight of a stop you get here. I've been running limit orders at fair value areas that I have high confidence in, and seem to be getting away with 5 to 10 point stops. Depends on the time frame. That's usually on the 1 minute. But yeah, typically I'm catching the second stage distribution from those high time frame fair value areas, so that I can get like to the tick entries. So obviously here's a chart example that might be able to help kind of conceptualize this. So here's a great example of what you might be looking for. So this is the example of why the zeussy market structure shift could fail. So here we have price retracing higher. Starting from up here, we have this low, move higher, we displace very, very strongly through it, retrace higher, but notice that we haven't actually tagged this bearish fair value area. So from here until here, this is an imbalanced price range. This is engineered buy side liquidity, and so we know that this could be a potential magnet for price later on. And so then down here we continue to expand lower, we have a bearish fair value area, and then we retrace into it and we continue to reject lower. This is engineered buy side because we haven't touched the bearish fair value area. Here we can see that we actually touched it to the tick and then we reject. So you might be thinking, okay, we go short here. Here we have SMT with YM, so we could be anticipating a low formation. And so essentially once this bearish fair value area fails, then we know that this high is the market structure shift in that zeussy market structure shift pattern. This is the retrace into the imbalance, and this is actually the high. So then we need to see it come through this high as our market structure shift, and then to continue higher up until our next target, which is obviously going to be that buy side liquidity resting above the bearish area. And something interesting to note is, let's take a look at what happens when you actually extend this bearish fair value area, which was used as resistance pretty much to the tick. So that once we move above it, then it starts to become a bullish fair value area. We reject from it multiple times and take off contracts at this buy side liquidity pool. You can go break even, leave runners, whatever you want to do. And yeah, essentially that's all I wanted to cover in this video. Hopefully it helps, and leave any questions in the comments below.